Hey everybody, today we're going to be looking at profit and loss statements, otherwise known as P&Ls. These statements are issued to our venues every single month, which works out our revenue versus our expenditure, giving us a net profit and ultimately allowing us to see the profitability or the losses within our business. We can go into quite a bit of detail with P&Ls. However, for today, we'll keep it quite top line and make sure we're just going through the facts. How to read your P&L, starting on the left-hand side, you're going to see the venue name at the top, which in this case is The Butler. The month we're going to be looking at is February 2022. And then the columns down below that is our revenue versus our expenditure categories, which when we ultimately move down to the bottom is going to give us our net profit. If we move across to one column to the right, we're looking at our current month. In this case, February 2022. Where it says actual, that is our actual data. So the revenue we've taken through our tills versus the expenditures or the costs that we've put out to run the business. Next to that is going to be our budget, which in this case is February's, and it will give us a variance at the end. Our budgets are released in July 2021 in this case, and that runs through to the end of financial year, which will be June. Year to date in the next column gives us the year to date figures from July 2021 through till February 2022. It will then combine the budget and the variance next to that. The next column, you'll see historical or budgeted data. As mentioned, the financial year from July 2021, you'll see very few figures in the first three columns up till September due to us being in a COVID lockdown. From October through to February, you're going to see actual figures based in there. March, April, May, and June underneath are the budgeted figures. The reason we put these in is so we can see how we're tracking in the final column, which is our year-to-date total. Alrighty, starting back on the left, we're going to be looking at our two departments first of all, so bar or beverage and food. Start with bar revenue, and we can see for the month of February, the Butler took $177,649 against a budget of $160,000. So we're in a positive variance of $17,649. Just quickly looking at year to date, you can see the venues tracking at $969,000 against a budget of 1.5. So we're over $500,000 down. This being looking across, as mentioned before, July, August, September, and October, you can see that there's no figures due to COVID. For our venues, all of our bar revenue falls into that top line there, bar one revenue. And so our total bar revenue figures are going to be the same as just mentioned. Underneath that, we're going to start looking at our bar cost of goods. Essentially, our cost of goods is what we've purchased for alcohol or soft drinks over the course of that month. For this example, the Butler spent $42,742 purchasing stock for the bar for the month of February. Our budgeted figure was $36,800, which means we've overspent by almost $6,000. Now, something to bear in mind here is although we have overspent, we are up in revenue at this stage by $17,000. So you would expect to see more purchases based on more revenue. Bar wastage line under here is any wastage that we ring through the till. So any mistake drinks that be made that are cashed off at the end of the night and then put onto our DTS. When we combine these two figures together, it's going to give you your total bar cost of sales. In this case, it's $43,229. So you can see versus a budget, we are overspent by almost $6,500. However, as mentioned, this would be expected to be a bit of an overspend due to us seeing an increase in revenue and more people through the door. What we're going to now convert this is to our bar gross profit. This essentially is taking the bar revenue minus the bar costs, which is what our profit is from beverage category at this stage after those two factors. So you can see our bar GP is sitting at 134,000 against the budget of 123. So we're up on GP. However, when we convert that as a percentage, we're actually down. So we budgeted for 77%. What this figure means is that for every dollar that we receive through the till, we should be walking away with 77 cents after we've purchased our stock to that dollar. In this case, we're walking away with 75.7. So we are under budget by 1.3. Now, because our revenue was up, we would expect this figure to be better. To give you an example, if we purchased $2,000 less in stock, those figures would align and we would have made budget as a percentage. Moving down, we're going to look at bar wages. So our bar wages are any of our front of house employees. As you can see on the left-hand side, it says bar wages, floor wages, and then our total bar wages. In our budget category, one thing to note is everything is just put into one line. So for the purposes of this, we're going to look at the total bar wages. We can see that the butler spent $47,585 in bar wages for the month against a budget of $37,600. So we're overspent by almost $10,000. When we convert this down to a percentage, it's 26.8% against the budget of 23.5. So variance of 3.3%, which is a big oversight in terms of running that department. Now, obviously, a couple of reasons for this may be staff training, also may come down to making sure that our rosters are rostered correctly, our staff are being signed off at the right point. When we look after this, it's our final line for our beverage category, which is our bar beverage contribution. What this is asking us for is the total bar revenue minus our cost of goods, minus our wages, is what we're left over. So from the $177,649 that we made in revenue, after taking out those two costs, which are our biggest costs in this business, we're left with $86,836. So whereas we were up by $17,000 in revenue, because of not great controls in those two categories, we're only left being up by $1,236. When we combine that as a percentage, it means we've got 48.9% against the budget of 53.5%. Therefore, for every dollar we're receiving, we're only walking away with 48.9 cents, whereas we should be walking away with 53.5 cents. What you can see from this is that by revenue being up, which is obviously a great thing, unfortunately in this department, our costs weren't controlled correctly, meaning that our bar contribution is actually down, whereas you would expect it to be up with stronger revenue. We're now going to do the same thing for our food. So food revenue in this case was $208,000 against a budget of $200. So we're up by $8,500. Our food cost of goods was $59,000 against the budget of $54. So again, we have overspent, but with an increase in $8,500 in revenue, you would expect to see this. When we convert that to a food gross profit, it means we're looking at 71.4 against a budget of 73. So we're down by 1.6. Now, a good thing to note in this department when our P&Ls come out, it's the responsibility of our general managers and head chefs to go through our general ledgers, which is basically a line-by-line detail of every single invoice that we've spent over the course of the month. In this case, when looking at food gross profit for the butler, the head chef noticed that there was an invoice that had been approved in there for the wrong amount of over $3,000. When you take this into account, it actually means that the gross profit would have been in line for the month of February. Moving down to food wages, we can see chef's wages, dishy, and then food total. Again, as beverage, we put everything in the budget line just under chef's wages. So we're going to, in this case, look at our total food wages as $51,000 against a budget of $55. So we've underspent by almost $4,000. This is obviously a great result. We're up in revenue. When we convert that to percentage, we're looking at 24.5% against the budget of 27.5. So we've underspent by 3%. So green ticks in that department. When we look then at food revenue contribution, as we did with Bev before, we're looking at the total food revenue minus our cost of goods minus our food wages. In this case, out of the $208,415 that we received, we're walking away with $97,781 against a budget of 91. So you can see as a percentage, that's 46.9%. So for every dollar we're receiving, we're walking away with 46.9%. So we're up on budget by 1.4%. We're up in revenue in this category. Our cost of goods are slightly down, but with really strong control of food wages, you can see that that's balanced it out at the end of the day to make sure that our contribution is higher than budget. Underneath here, you've got your other revenue category. As noted, anything down here could be other revenue that's something not from food and beverage. In most cases in our venues, you'll see things from events, for example, which might be venue hire, which would get coded in here. Down the bottom, the final part of this, we're going to be looking at turnover. So our total turnover is our food and our beverage revenue combined. We're going to minus out the total food and beverage wages and our total food and beverage cost of goods, which is going to give us the total contribution or what we have left afterwards. And then we'll convert that to a total contribution percentage. So in the case of the Butler, we can see we've got 386,000 in revenue against a budget of 360. So we're up in revenue by 26,000. We're walking away with 184,000 against a budget of 176. So out of the 26,000 we're up, because some of our controls were out, specifically in our beverage category, we're only now up by $8,000. So we've lost a bit of ground there. When we convert that to a percentage, we're looking at 47.8% against a budget of 49.1%. So we are down on budget due to those controls not quite being there. Essentially, that's the first part of our P&L, which when we talk about our top line. The next thing we're going to do is jump in and we're going to look at our expenses categories or our bottom line. Expenses categories are all split up into various categories, as we can see on the left-hand side of the screen. I'm not going to go through line and line as there is quite a bit of detail to go through, but we'll look at the general things that make up each expense category and how they then relate to the P&L. The first category we look at is administration expenses or admin expenses. When we're looking at this, a couple of things to note. Accounting and audit fees is what we pay our bookkeepers, who are Zorba, to do all of our financials for us. Consulting fees is what we pay Applejack Hospitality as a parent company. Printing, postage and stationery, pretty self-explanatory. And then you've got things like software support, which would be our licenses for things like IMPOS and Now Book It, etc. What we're going to start looking at down here is obviously the total expense line, but more so the percentage against our turnover. We're looking at admin expenses for the month of February. We can see that the percentage of turnover was 5.7% against a budget of 10.2. So we've underspent in this category by 4.6%. Again, an easy way to look at this is in the cents and the dollar scheme. So for every dollar we receive, we're spending 5.7 cents on admin expenses. Underneath here, you've got your advertising and marketing. So again, anything related to advertising and marketing costs are gonna hit this category. Split up down the side, digital, public relations, what we pay our PR company, DJs and entertainments, if we have live music or entertainment in the venues. We can see in this month, the total advertising and marketing We spent $5,700 in the venue against a budget of $3,000, which was 1.5%. So we're slightly over budget. February for this venue though, they did have an event on and which cost quite a bit of money. The next category underneath is something you'll be quite familiar with, which is our discount lines. This is just going through any staff discounts we offer, such as the 20% or the 50%, any customer promos that we put through our tills. As we can see here, we've spent $3,111 against a budget of $2,538. So we're slightly overspending this category. When we convert that to a percentage, it's 0.8 cents. So we just overspent in this category. The next one we have is operational expenses. Looking through here, it's anything that operationally we need to work that business. A couple of examples on the left-hand side: cleaning contracts is what we would obviously pay our cleaners, cleaning products, anything we use to clean, flowers and decorations, laundry, bar replacements, so any glassware, any kitchen replacements, any cutlery or plates. We scroll down one line, we can see for total operating expenses, we spent $9,700 against a budget of $10,000. So we're underspent in this line by $541. And as a percentage, we're underspent by 0.3%. So again, a good result. It means we're controlling those costs really well. Moving down a little further, we look at our R&M, or our repairs and maintenance. One thing to note in R&M is it's quite hard when we do release our budgets at the financial year to put everything into each category, because we don't necessarily know how much we're going to spend on electrical or plumbing throughout the year. So we essentially put everything as a total budget down the bottom. On the sides, you can see we're split up with electrical, plumbing, refrigeration, etc. Total R&M for this venue for the month was $9,665 against a budget of $3,000. So we've overspent by $6,000. Something to note here, when you're looking through your G&Ls, we can see that they had tree trimming done, which cost around $5,000. So those things which are probably one-off costs or annual costs aren't always put into our budgets, which you will then see a big expenditure. If you just scroll across to the right-hand column though for year to date, you can see that we're underspent in this category by almost $10,000. Property expenses is anything in the business that obviously is going to cost us for running the property: electricity, gas, pest control, waste removal, etc. So in this case, we're looking at spending $6,973. We've underspent by $1,000, meaning our percentage is down by 0.4%. So again, well-controlled costs, making sure that our electricity is switched off when we don't need it, making sure that our controls are all in line. Our final expense category down here is going to be employment expenses. So as mentioned before, in beverage, our front of house wages fall into bar wages, and our chef's wages all fall into the kitchen wages. Employment expenses is anything else after those raw labor costs. So the big one here is going to be our management wages, which is our front of house management team. We have other areas such as payroll tax, which obviously depends on the amount of wages we spend to the tax we pay. Staff amenities is any management tabs we have or anything we shout for people. Staff training down there, superannuation, workers' comp as well. So this one generally is a big category, as you can overspend in this quite easily. If we look at the total employment expenses for this venue, we're looking at almost $65,000 against a budget of $56,000. So we're overspent by $7,000. As a percentage of turnover, that's 16.6%, or 16.6 cents that we spent, which is over by 0.9. Underneath this, we're going to see the total expenses as a whole. So we're now going to add up every single category we've just been through and how much that's cost us. We spent $121,322 against a budget of $121,356. So we're underspent by $34, which is not something you see very often, but a good result. You can see that as a percentage based on our turnover, which was up, that's only 0.4% against a budget of 33.7. So we're underspent here by 2.3%, which is a good result. It means that our revenue is up, and although our top line costs weren't all very well controlled, our bottom line expenditure costs are all very much in line. And because of our increase in revenue, our percentage is higher down here. Now we've got net profit underneath here, but we're actually going to just run down to our other expense categories, which is our final ones, which we have very little control over. Under here, we've got our rent, which is very much static across the financial year. Any interest on any loans, potentially, which is going to give our other expense line. When we pop down to our final page on the P&L, we're going to see our net profit or loss. As we can see for the current month, after the revenue we took of over $300,000, after we take out all of our expenses, we're left with $43,211 against a budget of $35,306. So we're up by $7,905. When we convert this to a percentage, that's 11.2%. So that's telling us that for every dollar we receive through those tills, we're walking away with 11.2 cents to that dollar. We were budgeted for 9.8. So we're up by 1.4, which our revenue is up. Some of those costs are out top line. It's actually a solid result for the venue, making sure their expenditure lines are all in control. When we look at the year to date, our actual, we're sitting at $545,000 against a budget of $374. So we're up by $171,000. If we remember at the very top, we were down by around $500,000. But we've got some very strong controls in this venue, and we've had some very strong revenue over the course of summer, particularly November and December, which means totaling up as a percentage of 23.6% against a budget of 11.5. So we're 12.2% up against budget. So a very, very strong result for this venue for a February P&L, but also looking year to date, it means we're well ahead of the budget. That's pretty much a top line on profit and loss and P&Ls. We'll delve a little bit further into this in the future.